biggest question I get from people is, when is the next crash?
Okay. When is the next crash?
When is the next crash? Now, anyone tells you that they know when the next crash is lying to you.
So guys, today we will be talking about what are the investment trends you should be focusing for the next 3 to 5 years. So if you want to know where should you put your money, this video you don't want to miss out, because today I have a very special guest, Mr. Jack Kouzi, all the way from Australia. He's actually the founder and chief of strategy of BFS Group, to share with you where he will put his money. Okay, so before we actually go into the detail, do you want to first introduce yourself first?
Yeah,
What's
sure.
your background, the story, and how do you actually get started into investing?
Hello everybody out there. So I am an asset manager primarily from Australia. So we manage assets across the globe, pretty simple ones, you know, like equities, both in Australia but predominantly in Asia and the US. So that's kind of what I do most of the time. And then I get to travel around the world like this and talk to people and educate them online and through seminars like this. My background in investing, I've been investing since I was 16. It was the first time I bought stock. Now I couldn't buy it legally, so I bought it through my mother's name.
Okay.
So that was my first entry into the stock market.
So do you mind if I ask, how old are you right now?
Yeah, I'm 36.
20 years of experience?
Yes, not 20 years of good experience. You know, they say practice makes perfect, but that's not necessarily true. It's perfect practice makes perfect. You know, investing is a constant educational process, it's a constant experience, and you constantly have to learn because markets constantly change. So, I mean, that's when I first started, I lost all that money. But anyway.
So maybe I can add in one more question later on. What's the biggest lesson you have learned for the past 20 years of experience?
Don't think you're smarter than the market, right? You never think you're better, bigger, greater than the market, because the market is bigger than all of us. It's liquid, it's global, it moves the way it wants to move. It doesn't care if you're having a bad day. It doesn't care if you got bills to pay. It does what it wants to do. So be a constant student of the market is how I would summarize that. You know, what works sometimes doesn't work all the time. So that's why, you know, you've always got to educate yourself. And that's why organizations like this are really important, because not only do you get support, but you get different ideas and you get an organization that evolves with markets. That's really important.
So what's your career path after that, after you?
So I went to university. I did a commerce degree from the University of New South Wales. And then I started off in insurance, actually.
Oh, insurance?
Yeah. So I got a job at an insurance company and I was bored, really bored. And I wasn't really happy with what I was doing. So I resigned from my job, and then I started with an online broker. You know, ever since then, started my own firm. About a decade ago, and I'm thankful that I love what I do.
So some of the viewers out there might not have the chance to actually attend our current event out there right now. So maybe you can share with us, what is your outlook for the next 3 to 5 years? What is the investment trend that you are looking at, and probably you put your money to invest in those?
Yes, you know, the world is trending in certain ways. There are certain industries that are growing, and I talked about this at the event. You know, there are certain thematic themes that you want to look at. Now, primarily, I'm a value investor, but the question is, how do you identify value with so many things out there, right? There's exchanges all around the world. There are thousands and thousands of industries, millions of companies. How do you narrow out the noise and then apply the principles of value? So I want to see big things. I want to see mega trends or thematic themes that are almost irreversible, and that kind of gives me the best chance of making money in these markets.
So more of top-down approach.
Correct. Yeah. So I mean, tech is an overarching exposure to everything. I mean, I said this. You know, technology is no longer a sector. It's the driving force behind all sectors. So that is always at the core of what I'm looking for in terms of investment. In terms of some specific areas, I mean, you know, I believe China is and will be the center of the economic world.
Why? How come China?
Well, it's just, it has a law of large numbers. You know, it has 1.4 billion people. It's had a middle class of 400 to 500 million people. You got to remember that economies are driven by the middle class, right? People like you and I, because we eat, we consume, we go to restaurants. You know, it's not the poor and it's not the rich that drive an economy, it's the middle class. So they have a lot of them. And rising incomes, rising consumption. I really like China tech and the emergence of China tech. And this is the beauty of what I think about China is, can anyone at home name me a European tech company? It's hard to think of, right? Or one that's emerged in the last 10 years. Very difficult. You look at where the new world is emerging and where the ideas are emerging, they tend to be in the United States and China. You look at the biggest unicorns, so unicorns are like private companies that go to $1 billion. Most of them are coming out of the US and China. You know, ByteDance is a recent one, Didi is a recent one, which was the biggest private company. I mean, that's gonna list soon, and the same happens in the US, so don't overcomplicate it. buy them both.
Do you actually invest in private companies?
Yeah, I do. I mean, when you get to a certain point in your portfolio and you grow like I have over the last 10 to 15, you get an element of diversification and you get a further element of taking a little bit more risk. That's what growing your portfolio over time allows you. It then allows you to take risk because you've built that base, if that makes sense. Early venture can be very profitable, but it can also be very risky. Now, I'm at a point in my life where, I've been thankful enough to build a strong base that I can take some of that risk. So yeah, if you feel like there's a good opportunity, there's nothing wrong with that. And you can't apply value textbook for textbook, right? Startup companies don't have a PE, they don't have any earnings, right? But you can apply principles of, good business, good leadership, switching costs. Those moats we talk about as value investors can be applied and altered to early venture. But be careful, like anything else. But yes, I have done some early stuff, yeah.
So how do you structure your portfolio? Yeah.
I mean, conventional portfolio management says, you'll have maybe 60 to 70% equities, you have an element of 5 to 10% cash, and then maybe some fixed interest products and overweight. I am always long. Does that make sense? So I'm always long. So I'm never in cash completely 100%. I'm always long because markets go up. So they generally do, right? The question I think you need to ask yourself is, are you overweight or underweight? So are you overweight equities? Are you overweight value, overweight growth, or you're underweight? And that depends on what's happening in the environment. So, I've always got allocation to good value stocks. I've always got a core allocation to tech. The question is, am I overweight or underweight? Right now, I'm overweight.
So how do you determine when you're overweight or underweight?
Yeah, I mean, valuations come into perspective. Cyclical factors are effective. Markets tend to move in cycles. Industries tend to move in cycles. So I can't give you a simple answer on that, but I can tell you that the principles that you learn from this college and the principles of value will drive you in the right direction in determining when you're overweight and underweight. But biggest question I get from people is, when is the next crash?
Yeah, when is the next crash?
Yeah, when is the next crash?
In your personal point of view, right?
Now, anyone tells you that they know when the next crash is lying to you, right? Because no one can predict the next crash. I said this, it's harder to predict what's going to happen tomorrow. If you continue to wait for the crash, then it might not be a crash. The global financial crisis, we need to understand, the only other crisis that was similar to that was the Great Depression, which was 70, 100 years, 80 years before that. So, we might not see a crisis like that again. So if you're waiting for a 50 or 60% retracement of the markets, you might not see it, and it'll continue to go up. Markets rescind, we do go through periods, but you can argue we had a crash in late 18, early 19. The market pulled back 20%, 22%. So quality and value will always be your best friend. Quality companies will withstand anything that comes out of them. Sure, some people could come and go, but you look at something like a dividend aristocrat firm, they've been definition of dividend aristocrat is they've increased their dividends every year for 25 years plus. And you're talking about companies like McDonald's, they've been around for ages. So these are quality companies. It's never about time in the market, it's time in the market, but time in the right assets. That's the key. If you continue to try to time, you might not ever get into the market, and then you miss what happens.
So you actually talk about value and quality business, right? And there are also people talk about growth, right? So value investing and growth investing. So in your personal point of view, is there a difference or is it actually the same?
Well, in the end, it's all investing, right?
Yeah.
Okay, so when you invest as an investor, your primary goal is to make money. So the question is, what is going to make you the money? Now, value is value. There's always value, but value has had to change in the last 10 years because markets have changed with it, right? So what conventional value was 30 or 40 or 50 years ago isn't necessarily conventional value here. And I apologize for saying that. I'm not upset about saying that. Things change. You have the emergence of tech, which reinvests a lot of money, right? Which, are gonna put pressure on earnings and those ratios. You have excess liquidity in the market, which again puts stretches or alters valuations that we look at. So you have to have an element of both, right? And that's diversification. It's like you never put all your eggs in one basket. But when we talk about value, we're talking about things like moats, which I like to like. And that is something that will always be there no matter what. Is there a high switching cost? Is there good leadership? Does it have a brand name? Is it in a growth industry? Those things will never change. I get that sometimes, well, why are you talking about this stock? It's not clearly value. It's, you got to be a little bit diversified. So what's textbook 20 years ago isn't necessarily always textbook. And this is why I say you need to be a student of the market. You need to be part of organizations like this, because not only do they provide you with with education, but they also protect you and insulate you from some of the rubbish that's out there. Okay, and there's a lot of people that tell you investing is easy. It's not. If making money was easy, everybody would have money, and then no one would want money because everybody had it. Does that make sense? So you need to constantly improve on what you're doing.
So probably the last question.
We can talk for hours. I'm happy to. I mean, you can ask 20 questions.
So what is the biggest challenge that you see as an investor? Since you talk about
choice. That's the biggest challenge because
too many choices.
There's too many choices.
Okay.
That's the biggest challenge. I mean, you think about it. Not only do we have thousands and thousands, millions of companies, access to exchanges is much easier now, right? So, normally 20 years ago, you bought companies on your own exchange. So we're in Malaysia, you bought Malaysian stocks. You're in Singapore, you're in Australia, you bought Now you can buy anything. Then you have overlaying that. You then have ETFs on pretty much anything. You can probably get an ETF on brown shoes. I'm simplifying that. But do you understand? So there's ETFs on everything. So again, you're muddled with choice. It's confusing even for someone like a professional investor like myself. The choice is good, but too much choice then gives us confusion. And then the other thing is information. I mean, there's so many different opinions and so many negative opinions and so many that can sometimes confuse an investor and restrict them from what they're doing. So you got to narrow the noise out.
How do you narrow the noise?
Well, you got to be in sectors that you believe are going to grow. So I give you a couple of examples. I never buy oil companies.
Oh, okay.
All right.
I mean, oil is very important, at least in Malaysia.
Correct. Yeah, and this is a very way. But I mean, you look at oil, hasn't moved much in the last 5-6 years. I mean, you look at any Middle Eastern crisis, oil spikes, but doesn't spike as much as it used to. Now, why don't I buy oil companies, energy companies? No one wants oil. How old are you?
29.
29, right? You're young, we're young. The millennials, they don't want oil. You look at oil, 60% of consumption for oil is in the car. We're moving away from the car, from the electric car. We don't want it. Fossil fuels, we don't want that. Now, there has to be some limit in my choice. Otherwise, it's just too wide of a range. And sure, I might miss opportunities in that, but I want to see overarching growth, and then from there, I can start to narrow down my choice. The other thing is, I mean, you got to look where the growth is, and the growth is in the East. So, and I said this, you got to look at where the millennial populations are. They are in Asia, and the reason why you want to be part of high millennial populations is because what you'll see out of here is the millennials will earn more than their parents, and they'll spend more than their parents. That's the key. There's no point in earning money and keeping it under the bed. No one benefits from our companies. So that was what will drive growth. I really like the emerging markets as a value play going forward. I talked about that in my session last year, and then keep it simple.
So basically just focus on where the millennials will actually spend the money.
Yeah, that'd be a good place to start. Absolutely, yeah.
I think that's really good. A very good investment tips, I would say. Right? Investment nuggets for people out there to start their actually investing. So thank you so much for your time, Jack. And I hope you guys actually learned a lot and start investing and look into areas that actually got growth and actually got your interest. I will see you in the next video. Bye.